The collapse in crypto volume hit top exchanges hard, with spot activity down 39% in Q1. The important detail is not only price weakness. It is that fewer trades moved through the biggest venues, which means liquidity and confidence both thinned at the same time. A volume decline this large changes how every later rally should be read. Without returning participation, price moves can look stronger on screen than they are in the order book. Top centralized exchanges recorded $2.7 trillion in spot volume during the quarter, down from $4.5 trillion in the previous quarter. Average daily spot activity fell 27% to $117.8 billion. Those numbers show a market where participation shrank, not just a chart that turned red. Lower daily activity also reduces the information value of each move. A price candle formed on thin participation can be easier to reverse than one supported by broad trading across venues. Total crypto market value also fell more than 20% during the quarter. Bitcoin dropped more than 20% and underperformed major U.S. stock indexes in the comparison. That gap matters because it shows investors pulled back harder from speculative digital assets than from broad equity benchmarks. The comparison with stock indexes matters because crypto is often treated as the higher beta risk asset. When investors de-risk, the asset class with less perceived safety can lose participation faster. Liquidity is the practical issue. When fewer buyers and sellers are active, normal orders can move price more than they would in a deeper market. Spreads can widen, exits can become less efficient, and smaller tokens can feel the pressure faster than the largest coins. Market makers can also pull back when volatility rises and volume weakens. If they quote less size, the book becomes thinner, and traders may see worse fills even on familiar pairs. The slowdown was broad across major exchanges. Every top 10 centralized venue saw volume decline, and HTX had the steepest drop in the available figures, falling 55% to $133.6 billion in quarterly trading. A market-wide pullback is harder to dismiss than weakness at one venue. A decline at every major venue points to a change in appetite, not only a shift from one exchange to another. If volume had simply migrated, another top venue would likely have absorbed more of the flow. March was the weakest month for spot trading since November 2023, with activity around $800 billion. That makes the timing important. January and February still held near the trillion-dollar mark, then March showed a sharper fade, suggesting the quarter ended with worse participation than it began. March being the low point also gives a clean recovery benchmark. If later months cannot beat that level by a meaningful margin, confidence has not returned in a measurable way. The collapse does not prove the market cannot recover. It does show that any rebound needs depth, not only price. If prices bounce while volume stays thin, traders may still face fragile execution and sudden reversals because the order book has not rebuilt enough support. The recovery test is therefore practical. Can the market absorb orders again, or does each move still depend on a thin set of active traders? For the collapse to ease, the next signal is a return of daily volume, tighter spreads, and stronger participation across more than one exchange. A healthier market would show deeper liquidity before it asks traders to trust another fast move upward. Watch depth as well as volume. A single busy day can flatter the numbers, but repeated sessions with tighter spreads and reliable order books would show healthier participation.